Okay, so the next topic is cost curve and their shapes, and you can see that in figure 4 of the book. And there are some properties of this graph which are mostly the same for most of the companies, given that it's a competitive market. The first one is rising marginal cost. So the red line, the red curve, MC, is the marginal cost, and that's always rising. So when you're producing more, your marginal cost would always rise, and that's because of the diminishing marginal product property that we discussed. The second one is the U-shape average cost. So your average cost has a U-shape. So at the beginning it's very high, and then it goes down, and at the end it also increases uh, again. Um, so the sum of average fixed and average variable cost, average fixed cost falls as more unit is produced. So when you're producing more, the average cost is decreasing. So that's why there is a decrease in the average cost. And average variable cost increases due to the diminishing marginal product. Again, if your variable cost would finally increase because the new labor that you're employing, basically they cost much more as compared to the output that they're producing. So if you employ more and more employees, you will incur more average cost. Your average cost will increase, and that basically explains why this average cost increases back again. Uh, and as I said, it's because the additional employees are adding more cost, so to say, to the production of the product as compared to the benefit, or as compared to the output that they are making for the company. So the average cost, they will increase the average cost, and that's why at the end, as the quantity of output increases, the average cost also rises again. And the efficient scale is the quantity of output that minimizes average total cost. So the point, if you see, I think here is around 5 of the quantity of output. So around 5, or between 5 or 6, it's the efficient scale. It's the scale where the average cost is at the minimum. So that's the quantity. If that the coffee firm, for example, in this example, if that coffee shop produces 5 or 6 units of coffee, that will basically have, in that case, the average cost will be at its minimum. Okay, the very important point is the relationship between marginal cost and average total cost. The important thing is that the marginal cost curve crosses the average total cost curve at its minimum. So when you see the point, which is again about between 5 and 6 of the quantity, and I think about 130 dollars of the cost. So if you see the point where marginal cost and average total cost crosses each other, at this point the average total cost is the minimum. And there is an explanation in the book why it is the case, so I encourage you to read that. If I explain it, it will be a little bit complicated for myself as well. But yeah, so basically you should always remember that the point where marginal cost intersects the average total cost, that point is the point where the average total cost is at the minimum. And again, it also all comes back to the concept of the marginal diminishing product concept that we have discussed before. Okay, so I will briefly talk about three main properties of this graph, and then we will move to the next topic. And you can also see this in the book. So the first is marginal cost eventually rises with the quantity of the output. So as you produce more and more, the marginal cost will also increase. The second point is the average total cost curve is U-shaped. So your total average cost has a U shape. At first it declines, and then it's at the efficient level, and then rises again. And the reason is again because of the diminishing marginal product. And the third point is that the marginal cost curve crosses the average total cost curve at the minimum of the average total cost curve. So the point where average total cost curve and marginal cost curve intersects, that's basically the efficient amount of the output, which means at this point the average total cost is the minimum. So if you got these 3 points, you are good to go, and that's all the 3 main important points of this discussion. Finally, I will briefly talk about the last topic of this chapter. It's cost in the short run and in the long run. So as you know, costs differ in the short run as compared to the long run. In short run, there are some costs are fixed, you cannot increase it, but in the long run you can increase it. For example, if you have a company, in the short run you only have one plant for production, you cannot increase that within 1 day or 2 days to produce more vehicles, for example. But in the long run, and maybe in 5 years or 6 years, you can basically make another new plant and make another production plant, and then produce more cars. So some cost, the cost which is fixed in the short term, could be variable cost in the long term. So that was one example that I've given, that in the short term some of your assets are fixed, but in the long term you can change it. You can produce, you can make a new plant, you can increase your asset production capacity, and that also changes your fixed cost into variable cost. One important concept is the economies of scale. It's the property whereby long-run average total cost falls as the quantity of output increases. So this economy of scale says that in the long run, the average cost will reduce. As you produce more, your average cost will reduce. Why? Because you have achieved economies of scale, you have a bigger company, and your workers are more efficient, or the work is divided, and each employee is producing more of output as before. Sometimes diseconomies of scale also happens. That's the case when the property where long-run average total cost rises as the quantity of output rises. So diseconomy of scale is the opposite, that in the long run, if you're producing more, your cost is also increasing. So if that is the case, it's called diseconomies of scale. And one reason which is given in the book is that probably it's very difficult to coordinate activities if you have a huge company, and that increases your cost. But that's only one example. constant return to scale as the property whereby long-run average total cost stays the same as the quantity of output changes. So if you have a constant return to scale, your average uh, total cost stays the same as you increase your output, and you can see these explanations in figure 6 of the book. Okay, so that concludes our session, and in the summary you will find the explanation of these important different types of costs. So it's like a quick summary to recap what are the main different type of costs. And as I said, these terms that we have learned in this chapter will help us throughout the coming chapters, because we will use these terms to see how different markets works. And yeah, so that basically sets the ground for the coming chapter. The next chapter is about firms in competitive market, and that will also conclude this section of the book. And yeah, so that was all for today's lecture, and see you in the next class.